Imagine a global ETF that not only gives you global diversification, but also pays out more dividends than the classic dividend ETFs everyone talks about. Sounds impossible, right? But one new fund claims to do exactly that, and hardly anyone talks about it. How does it work? And is it too good to be true? Let's find out. Hello everyone, if you're new here, I'm Chioma. And on this channel, I talk about investing and personal finance. So if that sounds like a thing, give the video a like and subscribe so you don't miss out on future content. Alright, let's get into it. So the ETF we're talking about is the iShares World Equity High Income ETF, ticker WINC. At first glance, it looks like a normal global fund. It invests in large and mid-sized companies from 23 developed markets, drawn from the MSCI World Index. Its performance, though, is compared against the MSCI World Net Total Return Index, which includes both price growth and dividends after taxes, a fair benchmark for global equity performance. And here's where it gets interesting. WINC doesn't just track the index, it tries to outperform it. It does that by combining dividend income with something you don't often see in global ETFs, an options overlay. The fund starts by actively selecting companies that already pay higher than average dividends, global blue chips with reliable cash flows and dividend history. Then it adds an options overlay, selling call options and using index futures to generate extra income. Those options premiums are distributed to investors, creating a yield far higher than a typical dividend ETF like VHYL, all while keeping global diversification. Essentially, WINC is taking the kind of strategy used by covered call ETFs like JEIP and QYLD, but applying it to a globally diversified portfolio. That makes it far more balanced and less concentrated than funds focused only on a specific region like the US market or sector. When you look inside WINC, there's something you don't usually see in an equity ETF. Its top holding is cash, making up around 8% of the fund. That cash acts as collateral for its option strategy, allowing the fund to safely cover positions and generate additional income. The rest of the portfolio holds familiar global names like Nvidia, Microsoft, Apple, and JP Morgan. Many of the same companies you find in VHYL. It also holds money market funds and cash across several currencies, bringing the total to around 347 holdings. The expense ratio comes in at 0.35%, which is pretty standard for an actively managed ETF. And in the past 12 months, WINC paid out a huge dividend, about 9.7%, meaning a £10,000 investment would have generated roughly £970 a year in passive income. It's still a new fund, launched in March 2024, but so far it's posted an impressive annualized return of around 16%, including dividends. How does this compare to VHYL? VHYL holds more than 2,200 companies across global markets, is broad, well diversified, and fully passive compared to WINC's actively managed 347 holdings, which focus only on developed markets. VHYL also has a slightly lower expense ratio of 0.29% and pays a 2.87% dividend yield distributed quarterly. WINC's costs are a bit higher, at 0.35%, but its yield is far greater, about 9.7% over the past year. A £10,000 investment in VHYL will generate £287 annually, compared to WINC's £972 per year. Let's talk about fund size. VHYL has around $6.8 billion in assets compared to WINC's $168 million. But VHYL has also been trading since 2013, much longer than WINC. In terms of performance, VHYL returned roughly 14.5% in the last 12 months, while WINC delivered 15.99%, including dividends. In simple terms, VHYL gives you breadth and stability, while WINC offers fewer holdings, less global reach, higher income, and slightly stronger recent performance. Now, let's talk about the trade-offs. By selling call options, WINC gives up some potential upside when markets rally. So if global equities surge, you might not see the same capital growth you'll get from VHYL. The other consideration is consistency. That 9.7% yield is based on recent payouts. It's not guaranteed. And because the fund launched in 2024, there's limited historical data, so we don't yet know how it performs through a full market cycle. That said, it does carry the credibility of being managed by iShares, part of BlackRock, the world's largest asset manager. If your focus is passive income, whether for retirement or extra monthly cash flow, WINC could be worth a look. It's a middle ground between traditional dividend ETFs like VHYL and high-yield covered call funds like JEIP or QYLD. You're still getting global equity exposure, but with a much higher level of income. Now, for UK investors, that combination of global diversification and high income isn't easy to find. So, yes, it's now possible to have a global ETF that pays dividends higher than dividend ETFs. WINC combines global diversification with active income generation, something we haven't really seen at this scale before. Whether that income proves sustainable is the question. But if it holds, it could mark the start of a new wave of smarter income-focused ETFs. If you want to see how to fast-track your dividend income, check out this playlist next. It includes the best dividend ETFs for UK investors, as well as how to build up to £2,600 a month in dividend income. Thanks for watching, and I'll see you in the next one.